What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Amazon. My name is Leo, and what we like to do here, folks, is look at companies from an objective standpoint and from a value investor mindset. So let's load up Amazon into a stock research tool to jump right into it. So we have it loaded up here. We're going to look at three different categories. If you're new here, folks, I like to look at this first category called the company metrics. Now, this software you see in front of me is my own software that I have built that analyzes companies. And if you're interested, it will be available soon. It will be developed into an app. So let's jump through the company metrics of Amazon. And what we like to do here, folks, is take a look at the 5-year numbers of the business and compare them to the trailing 12-month numbers to try to gauge where this company currently stands and get an estimate of where it's going. So with our 5-year PE ratio, we're sitting at 101, which is incredibly high, but however, we are dropping down in our trailing 12 months at 46.24. Now, with our EPS, we are up over our 5-year average. Return on equity, we're also up over our 5-year average, and profit margin is up over our 5-year average. So far, right off the top, 4 categories here. I'm liking where this company is going, and Amazon it's a behemoth of a business, and I believe they're going to be doing a stock split. I could be completely wrong here. I might just be speaking off the cuff, but I thought I heard rumors of a stock split. I don't know. I don't listen to the news. Anyways, so 4 categories right off the bat, looking pretty good. Our revenue is sitting at $469 billion, so almost $500 billion in revenue, with a net income of $36.36 billion. Sorry, let me say that again. $33.36 billion in net income. Our free cash flow, however, is in the negatives, and our average is sitting at $11.3 billion. Now, this takes some. So I see this, and I'm kind of curious of why it's so low. So I'm wondering if the company's invested into certain things, and maybe made some purchases, because from dropping into the negatives from an $11.3 billion average is somewhat alarming and, well, concerning. But if they are investing into themselves, it's good to see. Now, with a return on invested capital, we're sitting just slightly below our 5-year average, and our Almond Z-score is sitting at 5.03, which is good. It's a healthy number. We want that to be over 3, and we have that. And our Piotrowski score is sitting at 6. Now, ideally, folks, we want this number to be between 7 and 9. 9 is the highest possible score we can possibly achieve. So 6 is somewhat mediocre. So right off the top here, just from what I've seen here with Amazon, I'm liking it a lot. However, this PE ratio is somewhat higher than I would want. But it is a drop from our current 5-year average, and everything is looking like it's on the up. Now, as I said earlier, this 5-year or this trailing 12-month free cash flow could be a potential issue, but if they're just making a lot of purchases, which I would imagine that they are, because it's Amazon, they're getting into video games, they have a movie business, like they're making shows like The Boys and the Grand Tour. So they have, the things are just naming off the top of my head. They're in a lot of different facets, right? They have Amazon Music, Amazon Prime Video. So I'm wondering what is next for this business. With this company metrics out of the way, what I'd like to do here next is go into our financial evaluations category to get a further look into the business. And if we load that up here, we are scoring this business a 5 out of 10, and you're probably wondering to yourself, how is it a 5 out of 10? Now, we'll go through these numbers right here, and here are the things that Amazon does right. We have a great return on equity average. We want this number over 15%. Our EPS growth is skyrocketing as we express. We were at 31.81 for our 5-year average. Currently, we are at 65.93. Phenomenal on the upside. Net income is growing. Our 5-year free cash flow, unfortunately, is not. Return on invested capital is sitting at a 5-year average over 10%. We want this to be 10% or higher, folks, and we have that, which is great. That means they make a great return on the capital that's being invested. Now, our revenue growth is also improving at 28.30% at a $1.56 trillion business. This is that the market cap actually? I don't know why I thought it was less. Looking at our revenue numbers here, we're up at 28.30%. Now that's phenomenal, and considering it's a $1.56 trillion company, trillion with a T, these are phenomenal numbers to see. So here's where Amazon gets some things wrong. At our 5-year PE average, we're sitting at 101. Essentially, we want this number to be underneath 22.5 because we don't want to be overpaying for growth. Considering how fast the company is growing, this might not be an issue if it can keep this growth up. Now, is that possible? $1.56 trillion market cap? It's highly unlikely. Our current ratio is sitting at 1.14. Now, folks, we want this number to be over 1.5. Now, what that would indicate to us is that they have enough assets on hand to cover their liabilities. Now, a 1-to-1 ratio is fine because you have enough assets to cover those liabilities, but we want that extra margin of safety, so that's why the 0.5 is very crucial. So technically, they could clear their debt. However, it wouldn't leave them with much wiggle room in case something terrible were to happen. Now, our debt to equity is our next category where they're getting some points off because it is sitting at 84%. We want this number to be under 50, folks. We want this to be under 50% because that means they're not going to be leveraging themselves through debt, but rather through the equity within the business. And that just equates to how much do the creditors have a stronghold on them. And this number is pretty high. We don't want to see that. We want to see below 50%. Now, with share dilution, this is a silent killer of a business that with 1.77% increase of shares over the last 5 years, they are slightly diluting you, and we want companies to either keep the share count the same or be buying back shares. So, listen, with the massive expansion that Amazon has had, it makes sense for the company to issue shares because, look, it's been blowing up over the last 10 years, and granted, with the whole pandemic that went down 2 years ago, and everyone turning to online shopping, Amazon Prime. Listen, it's the perfect storm. Store works as well because you have people stuck at home using online shopping, so it's driving, and the stock price is being driven up. Why not issue more shares? People are going to buy them anyways, and it's clearly evident because currently at the time of recording this video, $3,037 is the average share price for a company like this. Now, our 5-year free cash flow, as we discussed, is going down. We'll have to investigate why that's happening, but right now we are sitting at 0 points in this category because, well, it is lower than our 5-year number. But if they're using that to finance something or purchase something, then that's another story, and it could just be a one-off. So that is the financial evaluations. So comparing what I just saw, the company metrics and the financial valuations, my thoughts on this is that it's looking like it might be somewhat of an overvalued business, but I don't know. It's hard to say. We're going to jump into a price analysis to determine what I guess an applicable price would be to pay for this business. And let's do that right now. But before we jump into a price analysis, folks, if you're enjoying the video so far, please consider liking this video and subscribing for the most part. I would greatly appreciate that. It helps out the channel a lot. It makes me feel warm and fuzzy inside. And if you're liking this software, well, guess what? It will be an app for you to get onto. Just stay tuned for that. If you're interested, send me an email. My email will be down below in the description box below. That's invicticamedia@gmail.com, and I'll let you know when it's updated and online. So without further ado, here's a price analysis on Amazon. So here's Amazon. We got 3 analyses that we're going to do. We're going to do conservative, moderate, and aggressive. And if you know me, I like to try to be as conservative as possible to try to give myself the most margin of safety when paying for this business. We're doing a 10-year evaluation because I believe Amazon will definitely be around over the next 10 years, and it'll be a larger, greater company. I'm going to go ahead and populate these boxes, and then we'll discuss why I populated them the way I did. So stay tuned in just a quick second. Okay, folks, so I populated the evaluations categories. Now I am going to go as conservative as possible, as I said, because look, at 10 years, I can't expect this company to continue to grow at 25, 28, and 21% over the next 10 years. It just doesn't make sense. And with the amount of revenue that they're bringing in at $500 billion, almost $500 billion. It'd just be unrealistic. So that's why I stuck with the 10, 12, and 14 numbers. Now, some may say that is a little bit too conservative, but I have to be objective. I have to be conservative because I want them, essentially, I want them to crush these numbers. Anything higher than this, if they're able to bring that in, that works in my favor. But if I get a price that's accurate amongst these numbers that I've predicted, that's even better for us. So with profit margin, I'm keeping this at 3, 4, and 5%, because these are the numbers that they've able to hit between the 10 and 5-year numbers, as well as our 1-year number. This could very well ultimately increase as they get into different media spaces like gaming, as we discussed. They get into gaming, they're getting into their music platform. There's a lot in the works with Amazon, and they're building, I think, cashier-less stores. I think I read an article on that. They're bringing in cashier-less stores, and obviously they have some stores already that you could just walk in, purchase stuff. Besides the point, they're getting into a lot of different ventures, so this number may increase. Now, free cash flow margin, I'm going to keep that around the same, just because I'm just assuming where the company is now. Now, our price of free cash flow, we're jumping into some conservative estimates at 12, 14, and 16%, or at 16. We want this to be under 20 ideally. And same with our PE ratio. As the business gets larger, folks, you should be paying a lower multiple for this business. So our average was 101, and as you can see, it's 46, still pretty high. But as things grow within this business, we should be hovering around this mark, at least in the 10-year mark. It has to hit these numbers. So that's what I'm accounting for. We're going to put our desired return in. We like to do lucky number 13. And here is what we got, folks. Our average price comes out to be $1,200 a share. Current price is $3,000, $2,000 on the high side, $671 on the low side. Now, I potentially say that these numbers are essentially very, very conservative. And our moderate category, it's somewhere between the two here, maybe $1,000 a share. And you're probably wondering, how does that even make sense, Leo? How do you come up with these numbers? Well, keep in mind, folks, look at the PE ratio currently. It's at 46. You're asking to say 1/3 of the price. Well, that would essentially fit into that metric right there. And at 3,000, this essentially makes sense given the PE ratio that we're trying to assume in the future. Now, with our desired return, we could change that to be a basic 10% evaluation, and that would up the price that we have to pay. Like a considerable amount. But listen, you're buying an individual stock. You want to give yourself a decent margin of safety, and you gotta make it worth your while, because you can put it into an ETF that and that'll average you out around 10% a year. Take the chance, put something higher, and then if you're wrong, and it yields slightly lower, like maybe it does yield 10%. Okay, sure, whatever. But you want something that's gonna hit at the 13% return. So with Amazon, we're looking at almost $1,300 on average to pay for this business. Currently sitting at $3,000 a share. This is an overpriced business. Now, not saying I don't like the company. I love it. I use Amazon pretty much on the regular. I have an Echo. I want to make sure I don't say the name, but but I use it pretty much every single day. Yeah, it's a phenomenal business. I have a Fire TV. I have the Echo. I use the services pretty much all the time for multiple different things. And listen, Amazon Prime is pretty much been a staple of my family's life in terms of just ordering things and just it's been so convenient, especially when I'm on the road doing a bunch of crazy things and driving here and driving there, and I need to get stuff to the house instead of going shopping. It's always there for me, and a lot of you could probably agree. So the business is just integral to, I think, a lot of people's lives. And during this whole pandemic period, they've proven they've risen up to the challenge, and they've went to the plate, and they've pretty much just been batting home runs over the last couple of years and delivering things for people that would have been not seemed impossible, but I think they made living through the pandemic a lot easier for individuals, especially with those that were kind of frightened and scared to go outside. Ordering things from Amazon and ordering things online, they've broken through a lot of barriers. So enough of my rambling. What do I think about this business? this price just needs to come down, essentially be 1/3 of what it currently is now, and that would be a buy for me. I would love to own this business, but ultimately I want to pay a proper price for it. I don't want to overpay for it. And likewise, you should be thinking the same way. You can love a company, but if the price doesn't make sense, then why get involved with that product? We're looking for deals, folks. And just as, you know, Amazon Prime Day comes out or any kind of Black Friday deals, we want great businesses at great prices. So that's what we're trying to look for over here. You have to do your own due diligence. Likewise, I'm going to investigate this free cash flow fiasco. Yeah, my thoughts are simply that. Great company, great moat, because I don't think there's any other company out there with the potential of maybe being just Alibaba, AliExpress, whatever, that is based off obviously in China, that can essentially compete with them. But with the sheer volume that what this company moves, it's hard to find a competitor that can keep up with Amazon in the way they compose themselves, or not compose themselves, but at least how they operate. Ultimately, folks, the price is a little bit too high, and that's the spiel. If you liked the video, hit the like button, hit the subscribe button, check out more stock analysis videos up here, and I will see you in the next one. Thank you so much for watching. Until next time.